afternoon, ladies and gentlemen. We're going to get started. Thank you for attending the latest installment of the Option Industry Council's webinar series. My name is Nick Ziegler, and I'm a staff member here at the OIC. I'll be guiding you through today's session. We're glad you could join us to learn more about options as a flexible, powerful trading tool. In today's webinar, our Options for Me will explore the concept of options and their terminology, and will give you a base from which to start your options journey. As always, we'll cover the material, as well as your questions, in a quick 60-minute session. Our instructor today is a member of OIC's Investor Services team, Mr. Ed Modla. Ed started in the options industry in 1997, working with Blair Hall's trading group. After a number of years in the pits in both Chicago and New York, Ed traded independently and later transitioned to help investors and traders with both futures and options on futures. He joined OIC in 2014 and brings a special understanding of using options effectively, minimizing risk, and maximizing returns to our discussion. Please note that the windows on your desktop are resizable, so feel free to move the slides around for ease of viewing. At the top right of each box, you'll see buttons to maximize and minimize each window, so please use those, especially on the slides, so you have the best viewing experience. You'll also note that there's a box on the right side of your screen where you're able to submit questions at any point during the presentation. Ed will be responding to those questions during the final 10 or 15 minutes of today's session. Please note that this box is for content-related questions only. If you're having technical issues, the leftmost icon at the bottom, the question mark, is a link to our webcast provider's support page. Just under the questions box, you'll see a survey. Please fill it out at any point during the session so we can better serve you and investors like you with our future webinars. These survey responses are extremely important to us and will help guide our future programming. As I mentioned, there is a row of icons along the bottom of your screen. Each icon corresponds to one of the windows in the webcast, so if you rearrange your workspace and are looking for a specific part of the webcast, you can return to that part by clicking those icons. For your convenience, you can access a PDF version of today's content via a download link that's just below your slide window. And if you'd like to review the entire webinar, an on-demand version will be available a few hours from now via the same link you used to join us today. Additionally, our previous webinars can be viewed on the OIC YouTube channel. And don't forget that OIC has live events coming this fall to a city near you. Our evening seminar schedule kicked off in Chicago last month, and we have more sessions there, as well as upcoming seminars in the New York, Boston, Los Angeles, and Dallas areas. Make sure to check our full schedule at optionseducation.org. And now, ladies and gentlemen, Ed Modla will bring you our topic today, our Options for Me. Ed?
Thank you very much, Nick, for that introduction, and thank you to everybody for joining us here today. This is a basic presentation about some essential concepts and terminology that you will need to understand and become familiar with if you're going to trade options. We have a lot to get to, so we'll get started right away. First, our disclaimer: options are not for everybody. They're not suitable for everyone. There are unique risks involved in trading options, and you need to have a comfort level, understanding, and familiarity with options before you are advised to get started with trading options in a live account. The Characteristics and Risks of Standardized Options is a booklet that's required reading if you're going to get approval in an options trading account, and you can contact your brokerage firm to get a copy of that booklet. Also today, we're going to have some examples later on in the presentation. They will not include the costs of commissions, fees, margins, or taxes. Those are important in a live account, but we're going to keep things a little bit simple today, and we're going to keep those costs out of our examples. There's the disclaimer. Now, you might be wondering who the OIC is and what do we do. We're an educational entity. We're at the forefront of options education, specifically equity options. Our efforts are supported and funded by the options exchanges themselves. You see that listed on the screen here, along with the Options Clearing Corporation, or the OCC. So all of these entities, of course, have a vested interest in seeing that options are used wisely and effectively. So they support the efforts of the Options Industry Council, and it allows us to put on production like today, free of charge to investors and advisors, and also support the other efforts that we have, which are live events and the online education. Before we get to our outline for today, we're going to look at options volume really quick. And you can see here that in recent years, there's been an explosion in options trading and options volume in the industry. There's a number of reasons why this is the case, and if you asked 10 different traders, for example, why this has happened, you might get 10 different answers. But certainly on that list of reasons would be the advent of electronic trading. Of course, that has opened up the market's accessibility and speed frequency of trading, and that's, of course, had an impact on volume. But you also have a more widespread acceptance of options as a useful investment tool. And they can be used to accomplish certain objectives. For example, income generation in an account, or hedging an account's position against the potential loss in a position, or possibly speculating in the market in a unique way that only options can offer. So our presentation today is outlined with a lot of definitions and key concepts, and you will also be exposed to some familiar industry terminology and jargon. You'll know what a call and put is by the end of the presentation and how they work. You'll also be introduced to terminology such as in the money, at the money, and out of the money. You see towards the bottom of the outline here, ITM, ATM, OTM. We'll tell you what that is, how it works. So you should have a good comfort level and a base foundation for getting your options education started. Before we define calls and puts, we're going to talk about options from a broad perspective first. Options are versatile, and what I mean by that is they're an investment tool that allows you to capitalize on a market opinion, whichever direction that opinion is, bullish, bearish, or neutral. No matter what your market outlook is, there's an option trade that fits the narrative and would be profitable based on whichever direction you think the market is headed. To take that a step further, if your market opinion changed and went from bullish to bearish or vice versa or in any direction at all, it's very likely that you could change and adjust your options trade or position to fit your new market outlook. And that versatility is very useful for investors in their accounts. You also see a few highlighted words here: reduce risk and increase income. Those words on the surface may appear to contradict each other. Usually you have to increase risk to increase your income, but with options it's certainly possible to do both. Of course, that takes the right market outlook and the correct options trade and management of that trade, but the bottom line is you could simultaneously reduce your risk and increase your returns with options trades. Now we're going to get more refined with defining what an option is. At the heart of it, it's a contract traded between a buyer and a seller. A buyer of an option contract pays money, they pay the price of that option contract, and they receive rights. Specifically, they receive rights to execute a transaction in an underlying asset. And for our purposes today, that underlying asset is going to be a stock. So the buyer pays the option price, that's a debit right out of their account, and they receive rights to execute a trade in a stock. The seller receives the price of the option. The buyer pays the seller. That's a credit to the seller's account. In taking that premium, that income or credit, the seller acknowledges that they now have an obligation to execute a trade in an underlying stock. That trade that I'm talking about is going to occur at a specified price, and the option will define exactly what price that would be. The buyer and seller knows that price when they enter into the transaction. Also, options expire. They don't last forever. They don't go on indefinitely. So the option itself will have an expiration date defined. So these rights and obligations exist, and that executed trade that could occur if the buyer chooses to do so would be at a specified price, and the option will define that price, and the expiration date of that option will also be defined in the option itself. A logical first question might be, how do I know if I'm buying or selling when I own or I sell an option? And that depends on what kind of option you've traded. There are two types. There's calls and puts. So if you think about this in the most simplistic terms, there's really four trades you can make. You could buy or sell a call, or you could buy or sell a put. And which one of those four sides you're on will tell you if you will be buying or selling shares of stock. And when I'm saying shares of stock, I'm referring to 100 shares. A standard option contract will be on 100 shares of stock. The executed transaction is not 1 share, it's 100, and that would be for a stock or an ETF option. Now we're going to get into the specifics of calls and puts. This whole slide here is from the perspective of calls. If you buy a call option, what we know already is you've paid money. That's a debit right out of your account, and you've received rights. If it's a call option that you bought, those rights are that you can buy 100 shares of stock at your discretion. You can buy those shares at a price that's defined within the option contract, and the length of time that you own these rights will also be defined in that contract. If you're the seller of an option contract, we know you're receiving money. That's a credit to your account, and you're taking on obligations. If you've sold a call option specifically, that obligation would be to potentially sell 100 shares of stock, if called upon to do so, at a certain price that the option will identify. You have that obligation for a certain length of time, and you'll know what the expiration date of that obligation is. Now, here's some common terminology that I said we'd get into. Long and short. You may have heard these terms from an economist or a market commentator saying they're long the market or short the market. And in that context, it would mean that they have a position on or a portfolio on that would capitalize on a market move one way or the other. For example, if they're long the market, they would profit if the market moved up. If they're short the market, they'd profit if the market moved down. And we're not using these terms in that context today. From an option perspective, if you buy a contract, whether it's a call or put, you are long the contract. The buyer is long the contract. If you sell a contract, whichever one it is, you are short that contract, regardless of which direction you would profit on. You're short the contract if you sell it. Another very common term to get used to seeing, you'll see it a lot, is writer. That's synonymous with sellers. Sellers are known to have written options or write options or are the writer of options. Get used to different forms of that term. You'll see it as you move forward with it with your education, and it's synonymous with all option sellers, both calls and puts. Now we will get into puts and define those. So if you buy a put option, what we know about buyers is they pay money, they pay the price of the option, and they receive rights. In this case, with put options, you receive the right to sell underlying shares of stock at a defined price. You own those rights for a certain length of time. You'll also know how long that is when you trade the contract. Of course, same with calls. You're long the contract because you bought it. If you sold an option, what do we know already? You've received money. That's a credit to your account. You're taking on some sort of obligation to possibly execute a trade if called upon to do so. If you sold a put, that obligation would be to buy underlying shares of stock at a specified price within a given time frame. And again, similar to calls, anybody who sells an option, whether it's a call or put, is short the contract, and they could also be known as the writer of the contract. Now you'll notice through my presentation today, and as we move forward, there will be a lot of repetition. We'll go through concepts and terms over and over again, and that's by design. That's not by mistake. It is very important and useful to repeat things as you're trying to learn them. These are detailed definitions and concepts, and it's helpful to hear them over and over again. So we will do that throughout the presentation. Some of these contract terms I've talked about already. First of all, options expire. They don't go on indefinitely. There's some expiration date, and the traders involved with options on either side will know what that expiration date is. Now, contracts have specific terms to them. Each company or stock symbol will have a series of options that are traded on it with different prices, different expiration months, and you can look those up. You will likely type in a symbol you're interested in and find out what options exist on this particular stock or this particular company. So each option will have an underlying stock that is specific to that option. The unit of trade refers to what changes hands on that executed trade I said earlier. Buyers have rights to, and sellers may have the obligation to fulfill. What exactly is being traded? It's usually 100 shares. We defined it as 100 shares earlier, if you remember. The word usually is in there for a reason. Real quick, that reason is that it's possible for a corporate action to take place where shareholders are affected. This could be a spin-off, a merger, a unique type of stock split. And if that happens and shareholders are affected, it may be necessary to change the options in order to maintain a fair and orderly marketplace. So it's possible that this trade would not be 100 shares and it would be something different. Worth noting and keeping in mind, but for our purposes today, for a standard normal option contract, the unit of trade that changes hands will be 100 shares of stock. And then that specified price I referred to several times that trade would occur at is known as the strike price of the option. It's unique to the option contract itself. And then, of course, there's an expiration month. You'll know that the option contract will define it. Now, we're going to look at things a little bit differently here. This is entirely from the buyer's point of view. And this is somewhat of a recap on top, and then we'll introduce a new term on the bottom that's very important. We'll start out on top here. The option buyer has purchased the right to execute a trade. If they purchased a call, that right would be to buy 100 shares of stock at the strike price of the option. If they purchased a put, they have paid to receive the right to sell shares of stock, specifically 100 shares, at the strike price of the contract. If the buyer would like to execute that trade that they have purchased the right to do, then they would accomplish what is known as exercising the contract. That word is underlined for a reason. It's very important. You'll see it a lot. Exercises comes up frequently in education, and you'll use it when you speak to colleagues and other traders. So get used to it. If you want to execute the trade you have a right to do, you will be exercising your contract. You do that by letting your brokerage know of your intentions. Different brokerage firms have different procedures in place about when they would accept exercise instructions and how they will accept them. So you're strongly encouraged to communicate with your brokerage firm about how that happens and what their process is. But the bottom line is you communicate to your broker what you'd like to do. And if you want to exercise, you let them know. Only buyers can do this. You paid for rights. You paid to be able to make a decision. So only buyers can choose to exercise a contract. They can't be dictated or told what to do. A seller can't ask a buyer to exercise. The buyer has choices, and it's up to them. They can exercise or not. Now, here it's worth noting something within the industry that is standard practice. There has to be some kind of a default process of what would happen if someone who bought an option doesn't communicate anything with their brokerage firm. And that makes sense. There has to be some process in place. And some people might think, well, options might get abandoned and not exercised if that happens, or they might get exercised. The reality is they might get exercised, they might not. There's a process known as exercise by exception. If you're going to look a term up and review it later, you might want to jot that down, exercise by exception. And it defines what happens if an option buyer doesn't tell his broker anything. Does the option get exercised or not? And the answer is it might. And this will come up later in our presentation. It's worth noting here. Now we're going to look at things entirely from the seller's point of view. What we know about sellers is that they've received income, they've received premium, and had a credit to their account, and they're willing to take on an obligation. If they've sold a call, that obligation would be to sell 100 shares of stock at the strike price of the option. If the seller sold a put, their obligation would be to buy 100 shares of stock at the strike price of that option. Now, that would happen if they were called upon to do so, that executed trade. I'm going to change my terminology here. If called upon to do so means they are assigned an exercise notice. Underline word again, very important, get used to it. If the seller needs to follow through with their obligation, they will be delivered an assignment notice. That comes from their brokerage firm. So similar to the buyers who need to communicate with their brokerage firm, so do sellers. This just goes in a little different direction. Buyers proactively communicate with their brokers, and on this side of things, brokers proactively communicate with option sellers. You're certainly encouraged once again to find out from your brokerage firm, how do they communicate this to you? What form do they use to communicate with you, and what time do they communicate with you? Brokerage firms could be different from one to the next. And of course, sellers are the only ones that can be assigned. They received money, they were paid when the option transaction originally took place, and they were willing to take on that obligation when they sold the contract to possibly be assigned. Now, one question you might be asking yourself is, when can this exercise and assignment process take place? Does it only take place on that expiration date, or can it take place more frequently than that? And the answer is, for equity options, a buyer has the right to exercise their option on any day in between the time they bought that option and the expiration date, any day in between. Similarly, logically, sellers can be assigned on any day in between when they sold the option and the expiration date of that option. This timing feature of being able to go through exercise and assignment procedures every day up until expiration is defined as American style. That's what an American style option is, written out here. Buyers can exercise at any time on any day up to the expiration date. They're in total control. Sellers could be assigned at any time at any day up until expiration date. Now let's analyze this for a second. Buyers could, of course, exercise, that's what we're saying here. If an option loses value and expires without any value, they certainly could let the option expire. But they have a third choice, which might be a possibility. They could also execute a trade in the options market on the opposite side and close out the trade. That would mean putting in a sell order. You bought something, you bought this contract, now you own it. You can sell it whenever you want. You can put in a sell order and sell the contract back to the options market, get rid of it, it gets closed out of your position, you don't have to deal with exercise. Sellers can do the same thing. If they're not comfortable with their obligations at any point in time, they can see what price is available to them to buy back the option that they have sold, and if they're able to execute that trade before being assigned, their obligations will cease to exist. So that's one way to avoid going through exercise and assignment procedures, and in fact, statistics have shown that most options positions are closed this way and don't follow through and go to exercise and assignment. The vast majority are closed out through this fashion. So it's worth pointing out here when expiration is, and there's a few different explanations here. First of all, we'll talk about the standard monthly expiration day. For a monthly option, the standard normal monthly option, that expiration day is the third Friday of the month. This is the last day that options can be traded on their expiration day. So if you were trying to execute the trade I just described and close out a position, this expiration Friday is your last chance to do it, whether you're the buyer or the seller. It's also the last day that the buyer has the ability to exercise their contract if they choose to do so. Brokerage firms will have some cutoff time that you need to be familiar with, but this last expiration Friday will be the last chance the buyer has to exercise their contract. Monthly options that expire on this third Friday might just be displayed or quoted with the month name. There might not be a specific date or any more specific reference. If you see, for example, an option that expires in December and it's just listed as a December option, you would know this is a monthly option that expires on the third Friday of December. Now, some of you who've looked up option quotes might be thinking there's a heck of a lot more expirations out there that exist than just that, and you'd be right. Very popular in today's trading world are the weekly options that expire much more frequently. And this came from demand in the market. We talked about the explosion in volume earlier, and the exchanges noticed how many more investors are using options. So for a select number of symbols, more frequent expirations exist. That number of symbols now for weeklies is in the hundreds. I believe it's over 400 as we speak today. But by and large, it means that options expire every week going out a certain number of weeks. And they are looked at differently than monthly options from a listing or quoting point of view. For example, sticking with December, you might see December week 1 being specified, December week 2, and then December week 4. You might not see December week 3 because that actually references the standard monthly option. So from top to bottom, if you were looking for expiration months and you were looking up quotes, you might see December week 1, December week 2, December, and December week 4. That tips you off that that third one is just a standard monthly without designating that it's the third Friday. You would just know that. Now there's other expirations that exist. You have your quarterly options on a very select few symbols. But those don't trade as often as the monthlies or weeklies. They don't come up as often in questions and education, but they're there. If you wanted to investigate a certain symbol and what expiration months are available on it, you're certainly encouraged to look that up, and you might find more than just the monthlies or weeklies. So we're going to talk about option premium here. This is the amount paid up front by the buyer to the seller, the cost of the option. It's an immediate debit out of the buyer's account and an immediate credit to the seller's account. This is non-refundable, and it doesn't go anywhere. That's paid and received. The profitability of the trade then is determined by what happens after that. What kind of stock movement do you get? What kind of price movement do you get in the option? Of course, the buyer thinks the option value is going to go up from where they bought it, and the seller thinks it's going to go down, most likely. That price is quoted on a per-share basis. When you see an option quote or a trade, that number's on a per-share basis. Now, we already said that the transaction is 100 shares of stock. So if you see an option quoted at a price of $3, the amount of actual money that would change hands upon purchase or sale of that option is $3 times 100 to equal $300. We're going to go through an example here in a second. This will come up again, so we'll get more detail. But the point is, each quoted price or traded price on an option contract is on a per-share basis, and you would need to multiply that by 100 to figure out the actual total cost of that option. Now here we're going to go through an example, left to right. This is not a standard format by any means, but it's a start and a common, clean way to look at an options quote. Here you have 5 pieces, XYZ January, 40, call, and 320. The first part is the stock symbol itself. You're going to look that up, and you can look up whatever company stock you want. That first indication will be what stock is this possible executed trade going to occur on. That's what that symbol stands for. Next is the expiration month. Now this is where you might see something like January week 1 or January week 2. In this case, just see January. That's the January monthly expiration, third Friday in January. Third here you have $40. This is the strike price. The price at which a purchase or sale of the stock would occur if the buyer exercises their contract would be $40. That's the strike price. And then fourth, you have either call or you have put. That's the option types. It'll say one of those two things. And then lastly, you have the actual option price, seen here as $3.20. Now again, we just covered, that's on a per share basis. So you need to multiply 320 times 100 to come up with $320. That's what would change hands. So let's run through this in sentence format from the buyer's perspective and the seller's perspective, and that should clear it up. If you bought this option, you would pay $320 and you would receive the right to buy 100 shares of XYZ stock at $40 per share, and you would own that right until the third Friday of January. You could execute a closing transaction before then if you want, but you have those rights if you want them till the third Friday in January. If you sold this option, you would receive $320. That's a credit right into your account up front. And now you would take on the obligation to potentially sell 100 shares of XYZ stock at $40 a share. You have that obligation up until the third Friday in January. And whether or not you have to make that trade and sell the shares would be at the buyer's discretion. If you're assigned, you're obligated to do so. So that runs through that example. Now, we're going to go through a couple more common terms before we get to our examples towards the end of the presentation. First one is in the money, at the money, and out of the money. Now, before we talk about calls, which is what this slide is about, let's talk about these terms, ITM, ATM, and OTM from a broader perspective. Every option that exists can be categorized into one of these 3 terms. What it's defining is where the option strike price is when compared to the current price of the stock in the open market. For example, let's talk about in the money. If the strike price offers the buyer a better price to purchase the stock than the current stock price is going for in the open market, then that option is known to be in the money for calls. Call options offer you the right to buy stock. For example, up here, the January 40 calls up top. You could buy shares for $40. That's better than $50 in the open market. That's an in-the-money option. So strike prices lower than $50 would be in the money. $45, $40, $35, $30, and on down. You probably jumped ahead of me a little bit, and you'll know what out of the money means. If you own a call option that has a strike price higher than $50, that's a worse price than you could get by just going into the open market and buying the stock for $50. So everything above $50, $55, $60, $65, $70, and up would be an out of the money option. And then obviously at the money is where those two numbers match up. The strike price equals the stock price. That's at the money. Put options work exactly the same way, except the placement of in the money and out of the money are flipped. Think about what a put option is. If you own a put option, you have the right to sell shares. So at what strike prices is this right to sell shares at a better price than the current market offers you? Well, those would be all the prices above, in our example, $50. For example, the April 60 put, the last one on the list. You own this put, you could sell shares at $60. That's better than 50. That's an in-the-money option. So strike prices above 50 are in the money for puts. On the other side, out-of-the-money puts, if you owned them, your strike price is giving you the right to sell shares, but at a worse price than you could get if you just sold the stock in the open market. So that's out of the money for puts. And then again, at the money is where those two numbers equal each other. Here, $50 strike price, $50 stock price. Now let's go through a few examples of these. When you go through the webinar again, through its archived version, which I highly encourage you to do, go through each one of these, take your time and quiz yourself. We'll go through a couple of these at the top. First of all, stock price at $55, and we're considering the 65 strike price call option. So this is a strike price higher than the stock price is. If I own this call option, I have the right to buy shares at $65. That's worse than I could get in the open market, which is $55. So this option would be out of the money. Next one on the list. Stock price is at 77, and we're looking at the 70 strike price calls. Well, I have the right to buy shares at $70. That's better than 77. Strike price for this call option is lower than the stock price, so that's an in-the-money option. And on down the line, you can do the rest of these. For the interest of time, we'll move forward, but I encourage you to go through this a little bit more lengthy on your own and give yourself a quiz. Now we're going to go through one more concept before we get into our examples, and that is premium. We're going to break up premium into two pieces today: intrinsic value and time value. Time value is otherwise known as extrinsic value. Now, intrinsic value, by definition, is the in-the-money amount. In other words, for an in-the-money option, what is the actual price dollar difference between the stock price in the market and the strike price? We defined it in more generic terms a few slides ago. But for the purposes of option premium, the dollar amount that option is in the money by is the intrinsic value. Time value would be then any value above and beyond that intrinsic value that the option premium has. From a conceptual point of view, this is value that the options market provides an option or gives an option to account for the possibility of market movement and the option increasing in value in the future. There has to be some kind of acknowledgement that the market has volatility and movement, and that is where time value comes from. We're speaking on a very simple level today. There's certainly intense scrutiny that could be done on the time value portion of option premium, but we're keeping it simple today. This portion, this time value portion, is what decays over time. It might not be in a straight line down to zero, but when you reach expiration of the option, time decay is zero. That makes sense. There's no more time left. So if you're accounting for time of market movement and volatility, what happens when there's no time left? There's no time value. Time value is zero at expiration. That means at expiration, if an option has any value at all, the only value it has is intrinsic value. And if you follow me along here, that also means that at expiration, the only options that have any value are the in-the-money options. We're going to look at it from a little different perspective, and these are very elementary terms here, so if you think this is coming across too simple, don't think too hard about it. This particular slide is very straightforward. In-the-money calls and puts have intrinsic value because, simply, they are in the money. Intrinsic value is defined as the amount that an option is in the money by. They also may have time value. That depends on market forces and how much time is left to expiration. At the money and out of the money calls and puts, of course, don't have intrinsic value because, simply, they're not in the money. There's no intrinsic value there. So any value that an at-the-money or out-of-the-money option has is entirely time value. And this is the portion of the value that will decay and become zero. What the intrinsic value becomes is yet to be seen. The option can move. An option could have no intrinsic value today, but it could have intrinsic value in the future. So we're not sure about that part, but time value as you move forward and move down the calendar to expiration will eventually reach zero. Now let's look at some numbers and some examples here. We're going to look at XYZ stock trading at $53. And this is the example of the 50 strike price call option that we notice trading in the market or quoted in the market for $5.20. Now let's break this up into the two pieces. First question is, does it have any intrinsic value or not? You start out answering that by determining, is it in the money or not? In this case, it's a strike price on a call option that is below the open market stock price. That should tip you off. If it doesn't, take it one step further. If I owned this call option, I have the right to buy shares for $50. That's better than the open market would give me at $53, so that's an in-the-money option. How much intrinsic value it has is the difference between those two numbers. How much in the money is it? In this case, it's $3. By simple subtraction mathematics, you figure out what the time value is. We know the price is $5.20. We just figured out the intrinsic value is $3. So the remaining value of $2.20 is the time value. That's how you figure it out. Now let's look at another example down there on the bottom right. We're looking at the 60 strike price call option that's at $2.10. What is the intrinsic value? Well, intrinsic value is the in-the-money amount. Is this option in the money at all? The higher strike price for a call option versus where the underlying stock is trading in the open market. I could buy shares at $60 with this call option, but that's worse than I could get in the open market, which is $53. So this is an out-of-the-money option. That means it doesn't have any intrinsic value. Therefore, doing the same mathematics, this means all of that $2.10 that you see in the option premium is time value. And we're going to go through some examples here, just like we did before. And we'll run through these. And I encourage you to go through slowly and quiz yourself when you go through the webinar at your own leisure at a later time. But here you have a stock price at $77, and we're looking at the 70 strike priced call option. The premium that we noticed in the market is $10.50. The first question is, what is the intrinsic value? We need to answer that by figuring out if it's in, at, or out of the money. It's a lower strike price than the stock price. This is a call option. This means if I own the call, I can buy it at a better price than the open market is giving me. That means it's an in-the-money option. The amount of intrinsic value is how much in the money is it? In this case, that's $7. And the difference between the option price and the intrinsic value will give you the time value. This is the value that decays up until expiration, and in this case, $3.50. Let's look at the next one, stock price $58.50, and we're analyzing the 60 strike priced put option that we see valued at $3.75. First question, is this in the money, at the money, or out of the money? Well, if I own this put option, I could sell shares at $60. That's better than $58.50. That's better by $1.50. So yes, it is in the money by $1.50. The price of the option is being quoted at $3.75, and the intrinsic value we calculated at $1.50. So that leaves us with time value of $2.25. That's how you do it. It's simple math. So I encourage you to finish those up on your own and go through the webinar again in more detail. Finally, we're going to do two things here. We're going to have a buying calls example and then a buying puts example. And before we start here, I'm going to put a little disclaimer on that. I don't want anyone to get the impression that these are recommended first trades for options beginners. It's a beginner's webinar. It's an introductory webinar, but I don't want that to be interpreted as a vindication that these are common ways that beginning options traders start out, by buying a call or buying a put. You very well might do that, but you might not. As you go further through your education and you get more understanding with option spreads and the versatile nature of them and different things you can do, you might never buy a call or put. Then again, you might. So it depends what your objective is, what you want to do. My point is, this is not an acknowledgement that this is a proper way to start. It's just the essential concepts and material that you have to know. So let's move forward with buying a call. Recapping what we know about call buyers. They paid money. That's a debit right out of their account. they now have the right to buy 100 shares of stock at the strike price. They own that right until the option expires. And for that right, they've paid money and they've paid premium. Here's the graph of the P&L graph of what buying a call looks like. I highly encourage everybody to get used to looking at P&L graphs. And we'll elaborate a little bit here about how to create your own, but it's an incredibly useful tool to be able to visualize where you profit and where your risks are for a simple options trade like this or a more complicated one. It's something I was taught very early on and I've used ever since in my trading experience. Looking at a graph and seeing visually where my profit is, where my potential is, and where my risk is very useful. For the call buyer, a stock price that keeps going higher will produce greater and greater returns. And that makes sense. I own the call, I own the right to buy shares at a specified price. As the open market value of those shares goes up and up and up, the value, the worth of my option keeps going higher. And there's no limit on how high that could go. So the option profit potential is defined as unlimited. On the downside, and this is a nice benefit of options, the maximum loss is the amount you paid for the option. The value of that option can only go down to zero. It can't go any less than that. I'm going to tack on a detail here. That is true without fail as long as you hold the option contract. If you exercise into shares, or as I said earlier, we're put in a situation where an exercise into shares occurred on your behalf by your brokerage firm, your profit and loss graph changes dramatically. From time to time, I'll hear from an investor who says, wait a minute, I bought an option. I thought the most I could lose was what I paid for the option. I went to sleep on it for 2 months, woke up and found out I lost a lot of money. And it was because they didn't watch it, they didn't pay attention, they exercised into shares, and they had a lot more exposure than they would have if they had maintained management of the position. So be aware of that. Now we're going to put some numbers onto that graph. Here you have XYZ stock trading at $60 and you think it's going higher. You're bullish, but you don't want to buy shares. That costs too much money. That's a major cash outlay. And you want to limit your downside risk at least for a certain length of time. So you decide that a better investment for you is going to be to buy an option contract, specifically a call option with a strike price of 60, and you pay $3 for that. Keep in mind, $3 would be multiplied by 100, so you would actually have a cash outlay of $300. Now, this is how you can construct your profit and loss graphs, which I highly encourage you to do. You would select stock prices at expiration on the left, and then figure out what kind of profit and loss you have, and then plot those points on a P&L graph. We're going to start with a stock price that makes sense. Let's think about where we would break even on this trade. We paid $3 for the option. That means this option needs to be worth $3 at expiration for the trade to break even. Now, what stock price does that happen at? First of all, we know there's no time value at expiration. That means the intrinsic value of this option needs to be $3 at expiration. In other words, this option needs to be $3 in the money at expiration, or the strike price needs to be $3 below the stock price. If you followed along that math, a stock price of 63 would yield you an option value of $3, offset by your initial cost of $3, and total profit and loss is break even. That's a nice starting point for you. Then beyond there, you can choose stock prices at expiration below there and calculate out your profit and loss. You'll notice here for the duration of the option, you're capped out at a loss of 3. And then on the upside, what happens? You continue to profit, and we'll run across the top one, stock price at $70. This would be a $60 call option that is in the money by $10. That's the intrinsic value. That's the full value. Again, no time value. You paid $3 for the option, so your total profit would be $7. Your profit on this trade, you might notice, is not as much as if you just bought the stock outright. That's true. You paid for something. You gave up something which is a higher break-even point because you wanted benefits in return. You wanted a lower cash outlay at the onset, and you wanted to manage your risk more appropriately. You will notice commonly There's generally a cost and a benefit to trades or position adjustments that you do. So get used to thinking about what do I gain and what do I give up. From that graph, you can then plot your P&L. And here you go, superimposed with what it would look like if you just bought the stock. Doesn't quite do it justice on the graph here because you don't see just how drastic that downside can be. The stock price can go all the way down to 0, and you would lose the full price, which is from 60. But with the option contract, you can only lose what you paid while you hold the contract. Again, if you are exercised into shares, your risk profile changes dramatically, and you see where the break-even point is, and it's very important to construct and use when you're putting together your charts. So why would you buy a call option? Well, this is really explained with the graph itself. You're bullish on the stock. You want to participate in a move higher. You also don't want to spend all the money that it would take to buy shares, and you want to manage your risk more tightly. So those are the reasons. You would focus on the number of contracts. That would be specific to each investor depending on their financial condition. The price of the contract itself, different strike prices and different expirations would cost different amounts, so you'd look at that. Of course, your confidence level in the trade itself would play a role in figuring out how aggressive do I want to be and how many contracts would I like to purchase. So there's your motivations and considerations for buying calls. Now, the last thing we're going to go through today is a similar example, but all from the perspective of buying puts. So we'll get started with our recap. What happens when you buy a put? You have paid money, debited out of your account. You've received rights. For a put buyer, those rights are to be able to sell 100 shares at the strike price of the option, and you own this right up until the option expires. You've paid money, you've committed capital to purchase these rights. The P&L graph looks very similar, just with the arrow pointed the other way. Well, that makes sense. You own a put option, you could sell shares at the strike price. As the open market value of the stock moves lower and lower, that strike price you can sell at looks better and better. So your profit is to the downside here. Notice it's not defined as unlimited because a stock price is bounded by 0 on the downside. It's not bounded by anything on the upside. That's why there's a difference between unlimited potential for a call buyer and substantial but not unlimited for a put buyer. And similar on the risk analysis, you can only lose what you paid for the option. And I'll throw the disclaimer on there again, that's while the option exists. If you exercise or are exercised into short shares, meaning you didn't own shares to begin with, your option got exercised, now you're short shares, that risk profile changes in a big way, and you would have exposure to losses on the upside. So you have to stay on top of these things, be aware of them, and manage the positions appropriately. Now let's put some numbers on this one the way we did with the calls. We have a stock that's trading on 36, and you think it's stock trading at 36, and you think it's going lower. You want to capitalize on that move lower, but you don't want to sell shares short in your account because you don't want to deal with that upside risk. So you go into the options market, and you price one up, and you find a good investment for you would be to buy a put option with a strike price of 35, and you're going to pay $2.25. Again, the exact cash outlay would be $2.25 times 100 or $225. You pay that amount. Now you own this option with certain rights. We're going to construct our chart the same way. We're going to start figuring out, where does this trade break even? Well, I paid $225 for the option. This option needs to be worth $225 at expiration for me to break even on the trade. In other words, this option needs to be $2.25 in the money. I'm selling, I have the right to sell shares at 35, so that $35 number needs to be $2.25 better than the open market price. If you do the math there, you take 35, you take away 225, and your break-even point becomes $32.75. That is the stock price at expiration, where you would have a $2.25 valued option to offset your cost and break even. And then, of course, you choose different stock prices at expiration, going up, going down, choosing your strike price, choosing a high price, choosing a low price, and figuring out what your P&L is. From here, you can then take these numbers and plot the stock price versus your net profit and loss. And that's where you're going to come up with your specified P&L graph. Here you see your break-even point of $32.75, And again, you can see moving up, the loss is limited. You can only lose what you paid for the option. That's $225 in this case. And again, if you exercise and you have shares, that changes completely. You no longer have limited loss. You have a different risk profile if you're short shares. That would happen if you exercise or the option was exercised on your behalf and you didn't already own shares to offset that and ended up with short shares in your account. So be careful and be aware of that. Motivations, why you would buy a put. Look at the graph, think about the graph. You're bearish on the stock. You want to capitalize on that move lower. But you don't want to take certain risks. Specifically, you don't want to deal with the risk of the stock moving higher against you and having to figure out, where do I put a stop loss? Where do I get out of this trade? That can be stressful. That can cause you to lose sleep at night. So you want to participate in the down move. You don't want to have risk on the upside. You don't want to also deal with margin that would be required to hold a short stock position in your account. So these are the motivations for why you would buy a put option. That gets us through the material today. The options education program that we support is invaluable. There's a MyPath assessment that we have on our website, which allows you to take a brief quiz and go through the material and have a customized education path laid out for you. Or if you'd like to just go through at your own speed, there's podcasts, videos, and written material for you to go through. Of course, we have seminars and webinars like this one, and they come up frequently. So what we do at the Options Industry Council through our website and the Options Education Program is excellent material for anybody at any level, beginner, intermediate, or advanced. Here's the website again. I mentioned it in the beginning, www.optionseducation.org. I can't stress enough. We are at the forefront of equity options education. So go to the website, go through the material, register for free, and sign up and reach out to us if you have any questions. There's also a mobile app that you can go through, and the OIC maintains a YouTube channel with archived versions of videos and webinars such as this one that you can check out as well. So that wraps things up, and we'll turn things over to Nick to get things finalized.
Well, we do have a couple questions today, Ed. I want to reiterate a point you just made about following up on the website. If you do have questions about the concepts we submitted today or any of the tools on the website, feel free to check it out, poke around. But if you need some additional assistance, feel free to contact Ed or another member of the Investor Services team at options@theocc.com. They're ready to help you answer the questions that you have about option strategies or positions. And as Ed mentioned, today's session will be archived, and it should be accessible in a few hours using that same link you used to join us today, as well as on our YouTube channel, so you can review a number of option strategies and concepts at your own pace. And without further ado, Ed, we do have a number of questions. The first one, you used the term deep in the money a number of times. What does that mean to be deep in the money?
Well, we talked about what in the money was earlier. By definition, that was if you own an option, that strike price of the option affords you the right to execute a trade at a better price than the open market stock price is affording you. A deep in the money option is a general term that refers to a strike price that is far away from the open market stock price. It's somewhat arbitrary. But the deep term is an indication of where that option sits in relation to the stock price, and specifically, if you remember that call options have an in-the-money area that's strike prices below the stock price, those would be very low strike prices as compared to the stock price. On the flip side, for put options, since you're selling shares, strike prices that are very high and very far away. So it really is a way to characterize the distance that that strike price is from the underlying stock price. That's all it is.
Ed, a number of our listeners wanted to know about exercising prior to expiration. Can they exercise long options at any time prior to expiration?
For equity options, the answer is yes. And we talked about that near the beginning. The definition is American style. And what this allows an option buyer to do is exercise their contract on any day in between the day they execute their trade and become long the contract all the way up till their expiration date and any date in between. So the buyer has this right, and it gives them the ability to exercise whenever they want. Consistent with that, the seller has the obligation or the potential to be assigned on any day at any time all the way up until expiration. And that is a characteristic of equity options, and specifically that timing of the possibility of exercise and assignment is known as American style. So the answer is they can exercise it on the day they bought it, on the next day, or any day all the way up till the last possible day of exercise, which would be the expiration date of the option.
A number of our listeners today, I think they're looking for very practical tips in order to get their options journey started and hopefully turning a profit on that. So let's say that an investor is bullish on a given stock. Is it better, in your opinion, to buy a call or to sell a put on that stock?
That's a really good question. The difference between the two would be centered around how aggressive you wanted to be with the trade. So, of course, those two trades would profit and capitalize on a market move in the same direction, but they would have a different P&L graph. You remember when I went through the examples, I stressed analyzing a profit and loss graph, and if you're thinking about buying a call versus selling a put, compare those two and see exactly what the difference is. But generally speaking, buying a call option is an aggressive trade, and you would need the underlying stock to move in your favor, usually, to see a profit, whereas selling a put is a little bit different. You can only profit the amount that you sold the option for. You can't profit any more than that, but you would be able to profit on less of a move in the underlying. For example, if you sold an out-of-the-money put option and the underlying stock didn't move anywhere, you would profit on that trade just based on the time decay of that option, which would yield a value of 0 at expiration. On the other hand, if you bought an out-of-the-money call and were thinking of that as an alternative, you would need movement in the direction higher in order to see profits on that trade. So there are some comparisons to make between the two. Buying calls would be a cash outlay and a more aggressive trade, but with more profit potential. On the other hand, selling puts would be a credit into your account. You would capitalize on time decay, but your profit potential is certainly limited to the amount you received when you sold that option. So different profit and loss characteristics. And if you really wanted to analyze that trade, I'd go through and construct a simple graph the same way we did buying calls today, and do another one selling puts, picking your strike price, figuring out your break even, plotting those P&Ls against the stock price, and taking a look. I suspect that the decision to buy a call versus selling a put may be different from one trade to the next, depending on your confidence level. I say this all the time to investors that ask me questions regarding which trade should I do. The answer is, I don't know that. You have to figure that out in part based on what your market outlook is and how much confidence level, what your confidence level is in that market outlook. Then you can analyze your risk, your reward, and your break-even point and figure out which trade is best for you. So that's how I would answer that question.
Ed, there's quite a bit of information that you threw out today, especially as it pertains to buying and selling both calls and puts. Can you review some of the risks and obligations for put sellers for our listeners today?
Sure. When it comes to put selling, it certainly is a complicated concept, and it takes some time to wrap your head around it. Put sellers receive income, as we've talked about. They are paid into their accounts, and they're willing to take on an obligation. Now, think about that obligation. That would be to sell, if you sold put option, that obligation would be to buy shares of stock at the strike price of that option. Your profit potential, just like when you sell any option, is the amount of premium you receive. You can only make that much. The value can only go down to 0. The loss potential would be if the stock price moved lower. That's because as a put seller, you're under the obligation to buy shares at the strike price. If the stock price moved underneath that strike price and kept going lower, the value of that put option would keep going up, and you would be still under the obligation to buy shares at that strike price. So your risk would be a move lower. Again, if you wanted to look at a trade, pull up a quote, draw a chart, put up a graph, plot it, and take a look at how this looks for you. Some investors are comfortable with that. This could be in large part because they want to own the shares anyway and they're comfortable with that strike price. So there could be different motivations involved. You may or may not be comfortable with being assigned and owning the shares. Some investors are, and some investors aren't. But those are where the risks and rewards are. And again, the P&L graph will help. And knowing what your motivation is and what your objective is going into the trade will also help you.
Ed, does the strike price change depending on the contract term?
Well, if I understand the question correctly, I'm going to answer it this way. The strike price does not change, but there are various strike prices that exist. If you looked up stock XYZ for a certain expiration, say October monthly expiration, you would see a number of different strike prices, up and down, 35, 40, 45, 50. So different strike prices attached to calls and different strike prices attached to puts. Those strike prices don't change. So if the buyer ends up exercising, they would be purchasing shares at the strike price that they knew about, that was defined in the contract when they initiated the position with the initial trade. Same thing holds with the put buyer or on the seller's side, the obligations. The seller knows what price that executed trade would have to occur at and where his obligation is, and that price does not change. So no, the strike price does not change over time. It stays constant, and that's what allows you to analyze a trade and forecast out into the future at different stock price levels. What might this option be worth? Because you know what the strike price is today, and that's going to stay constant all throughout the option's lifespan.
Ed, we're coming up on the end of our time. We have, I think, time for two more questions here, and this first one is, if you're allowing the call option to expire, are you forced to buy that stock?
Very good question. There's two perspectives. If you're allowing the call option to expire, that could mean the call is out of the money and it's worthless and you're just allowing it to expire. In that case, if that's true, then no transaction would take place, exercise wouldn't take place, and the option would simply expire worthless. If the option is in the money and you would like to abandon that option and let it expire without exercising, you would need to communicate that with your brokerage firm. So here's another tip-off or reference to communicating with your brokerage firm. How do I notify you of my intentions of what to do with my option? And what happens if I don't? If an option is in the money and you don't communicate to your broker any intention, it is very possible that your option could be exercised on your behalf and you would end up with shares in your account. You need to be aware of that. So communicate with your broker and make sure you don't have a surprise position in the stock after expiration. One way to avoid that, we touched on it today, would be to, at some point, sell the option back into the options market. If it has value and you're comfortable with it and you don't want to take any chances with exercise possibly occurring, you can see what the price is in the options market, put in an order to sell the option that you own, get rid of it, it disappears from your account, and you no longer have to deal with the exercise process.
Ed, one last question today as we are quickly running out of time, but this is kind of an open-ended one, but I'm sure you get it a lot. What's next for our listeners today? How do you become more of an expert in understanding, trading, and being active in the options space?
Well, I tell you what, there's no easy answer to that, and you're right. People call me up a lot, and they ask, what's the magic trade? Which trade works best? And what I say is this, options trades do as they're defined to do. The P&L graphs don't lie. You have to have a market forecast and an opinion on what direction you'd like to capitalize on and then fit the right options trade to that market narrative. So it's not as if there's an options trade that is better than any other or is more profitable than any other. I encourage people to keep in mind options will produce as they're defined to according to what happens in the market. So your outlook is very important. And for people getting started, I constantly have to remind them that your market opinion will then dictate what kind of trade you want to make. What expiration date might you be looking for? What strike price might you want to trade? What exact trade do you want to make? You just asked, so a question earlier was, do I want to buy calls or sell puts? These are all questions that I get asked, and I don't know the answer because those answers are derived from what's your market opinion, what's your market outlook, where do you think this stock is going, and in what time horizon do you think it's going there? So when you put all those things together, then you can learn through our educational website and by contacting us, attending our webinars, what types of trades will capitalize on the market forecast that I have. And when you put those two things together, that's when you can be successful trading options. Of course, there's a third piece, managing that position appropriately and getting out at appropriate times and taking your profits when you can. But when you're starting out, those first two pieces have to come together, and then you can take it from there and manage the trades as best you can.
Ed, thanks so much for your time and expertise this afternoon. Do you have any other closing comments for our listeners today?
Well, yeah, briefly, what I wanted to say is we covered a lot of material today, and I hope everyone found it useful. I certainly enjoyed my time here. And these concepts and definitions, they are logical, but it takes a high level of concentration to absorb them. And that's why we repeated terms over and over and repeated concepts over and over, because they really have to sink in. And when they do, the light bulbs start to go off, and you'll become more and more familiar with this. So if you think it's confusing and there's a lot of material here, you're not alone. It takes everybody some time to learn anything. But options are a useful tool in any portfolio. I'm a firm believer in that. No matter what your objective is, options can help you out. You've seen the volume explosion. There's a reason for that. So I would encourage listeners to stay committed, to get excited about this, to go to our website, sign up, register, go through the educational material we have, and reach out to us and utilize us as a resource. That's what we're here for you. And I'm confident that our material will help anybody get started to put options into their portfolio and hopefully at the end of the day, increase the returns you see with your assets.
Ladies and gentlemen, thank you so much for your time today. While we weren't able to get to all of your questions, I noticed quite a few came in just there at the end. We do have Ed and our investor services team ready to help. Feel free to reach out to them at options@theocc.com. Many of you also asked about further education. Please visit our website at optionseducation.org and see the Getting Started section for further reading. As we've mentioned, today's session will be archived and accessible in a few hours using that same link you used to join us today, and our webinars are available on the OIC YouTube channel, so you can review those option strategies and concepts at your own pace. And of course, make sure to check optionseducation.org in the upcoming weeks for our next online sessions. Our next webinar is going to be held on October 27th, when Ed actually will be talking about generating income with options. And additionally, if you're in the New York, Chicago, Boston, Dallas, or Los Angeles areas, please come to one of the OIC's evening seminars this fall. The full schedule is available on our website. Ladies and gentlemen, thank you for attending, and we hope to see you again next time.